Hi there. In this business topic video, we're going to take a look at two key ratios that are associated with the returns that shareholders earn from their shareholdings in business. We're going to take a look at shareholder ratios. Now, you may have come across a whole series of different ratios in relation to business performance and financial information, perhaps come across liquidity, which are to do with the cash position of a business, profitability ratios concerned with the profitability or the return of the business as a whole. Shareholder ratios are quite specific in the sense that they look at life from the perspective of the shareholder or the owner of a business, and they concern and try to assess the return that the shareholders get from their investment. So let's take a look at the two key ratios, but also think about how shareholders get their returns. When you are a shareholder, you're aiming to try to get at least one, but ideally both, returns from your shareholding. Firstly, the business may decide to issue a dividend, which is a payment to shareholders out of profits. And also, you're trying to hold on to the shares until their value increases compared with the price that you first paid for the shares. So the increase in the value of your shareholding, this is known as capital growth, or very commonly known as a capital gain. And ideally, as a shareholder, you get both of those returns during the course of your shareholding. Dividends are worth noting down. If you've not come across this term before, you don't need to know a lot of detail except to understand that this is a payment out of the reserves or profits of the business that is made to the shareholders, and the dividend is usually declared per share, an amount per share, for example 10p per share held, and therefore obviously shareholders with more shares get a slightly higher dividend because it's more shares times the dividend per share. Now, most companies don't have to pay a dividend out. It's usually a voluntary thing that the board of directors will determine. But in reality, most companies whose shares are listed on stock exchanges do pay a dividend. Capital growth is a slightly different concept. The idea here is that you buy your shares for one price and hope that that share price will increase over time, giving you the opportunity to sell for more than you bought the shares for. So a capital gain or capital growth arises when the value of the business increases, and a good proxy for the value of a business increasing is an increase in the share price. But of course, that capital gain only really arises when you sell the shares. So whilst it might be there on paper, it only becomes a real gain that you can go away and spend once you've sold your shares. And of course, the other point to remember is that the share price or value of a business can go down as well as up. So it's entirely possible, indeed often likely, that you're left with a loss on the value of your shares if you buy at a price that's too high and the share price subsequently falls. Now, when we're looking at shareholder ratios, there are two ratios to consider, and we're going to go through these just briefly, give you an example to show you how they're calculated, but also point you in the direction of one or two key evaluation points that you can use if you're required to write an answer that uses shareholder ratios. On the screen there, the two shareholder ratios we're going to look at: dividend per share and dividend yield. Dividend per share does exactly what it says on the tin. It measures the amount of dividend paid to each share. And the dividend is usually declared either once a year or twice a year. And it's therefore an absolute measure of return. So if the dividend price was 5p per share, that is what the shareholders get for each share they hold, an absolute return of 5p per share. Dividend yield is slightly different in the sense that it is expressed as a relative measure. It's expressed as a percentage. And the calculation, as we'll see in a second, is the dividend paid out expressed as a percentage of the share price to give a feel for the relative return on investment. So let's have a look. Firstly, how do you calculate dividend per share? Well, the calculation is shown there on the screen. Dividend per share is expressed in terms of a monetary amount. So for example, it could be pounds. And what you do is you take the total dividend paid out and divide by the number of shares in issue that qualify for the dividend to get your dividend per share. So it's a simple division calculation. Here's an example. Let's say that the total dividend paid by the company was £500,000 or £500,000. There were 10 million shares in issue that each qualified for a share of the dividend. That means that the dividend per share can be calculated by dividing £500,000 by the 10 million shares, and that should give you 5p per share. So if every share you hold of the 10 million, you'll get 5p dividend. And to work out your total dividend, simply multiply 5p per share by your shareholding. Now, how useful is dividend per share as a shareholder ratio? Well, of course, it is just a very basic measure of the absolute return that a share returns, that the shareholder receives. But you can probably already see from this ratio that there are one or two problems with it. Firstly, we don't know how much the shareholder paid for the shares. And indeed, many shareholders would have paid different prices for their shares if the business is listed on a stock exchange. So we don't know what that dividend per share means in terms of a return on what they invested in the share in the first place. And also, it doesn't tell us how much of the profit that was earned by the company was distributed as a dividend. So, for example, in our case, we distributed £500,000 as a dividend. Well, was that all the profit that we earned, or all the reserves we could have distributed, or was it just a small proportion? How generous is the company being in sending out its dividends to shareholders? So dividend per share is a pretty limited measure of shareholder return. Dividend yield perhaps is a slightly better measure. Let's just have a look to see how it's calculated. Dividend yield is a calculation and it's expressed as a percentage. So you take the dividend per share, which of course we calculated earlier, and divide it by the price of the share price. And typically that is the latest share price. Now, of course, not everybody would have paid that share price, but it's the best measure we have. Let's have a look at an example. Let's say that the dividend paid per share was 10p per share. And the latest share price, according to the FT or the stock exchange, £1.75. So as it stands, what is the dividend yield? What could shareholders expect if they were to be paid a dividend of 10p, and if they were to buy now at a share price of £1.75, we simply divide one by the other and express as a percentage. So 10p, the dividend, divided by the share price of £1.75, times by 100, express a percentage, that's a 5.7% dividend yield. Now, is that a better measure? Well, I guess in certain circumstances, it is a better measure than dividend per share. For example, you could compare the dividend yield of your business, your shareholding, with the alternatives, maybe other similar companies on the stock market, to see whether they pay out a higher dividend yield. You could also compare the dividend yield with alternative investments. 5.7% doesn't sound too bad, does it, when interest rates in the UK are 0.5%? And of course, savings rates are very low, so that looks like a decent return. So dividend yield can be useful for shareholders as they consider whether to invest in a share in the first place, particularly if they're looking to invest in a business that pays out relatively high dividends. In other words, the shareholder can expect to get a sensible dividend income each year. But of course, you need to be a bit careful with measures like dividend yield, because don't forget the bottom line of the calculation, the denominator, is the share price. And of course, the share price moves up and down. So a high yield might suggest that the share price is particularly low, or that the market expects the dividend to be cut at some stage in the future. So dividend yield is useful, but don't forget it's subject to variations in share price changes. And of course, it varies, therefore, day by day. Well, we've had a look there at two of the key shareholder ratios, and I just thought it'd be useful to stick on the screen there just for a minute or so some examples of these two shareholder ratios in action. So I've listed 4 companies there that you may be well known to you, just to show how the calculations work and how the dividend per share and dividend yield vary between companies. Now, of course, this is a good indication of how share prices differ. So, for example, Apple, the world's most profitable company, has a share price of $110 as I speak, and it pays a dividend per share, or the latest dividend was just over $2. that would be an effective dividend yield of around about 2%, 1.9% if you were to invest in Apple shares today and get the same dividend next time. GSK, the big global pharmaceutical business, has a much higher dividend yield. It pays out a much higher dividend relative to the price you have to pay to get one of their shares, which at the moment is £14.87. But look at the bottom, ASOS, the pure play e-commerce retailer. It doesn't pay a dividend. It assumes that investors are simply interested in investing for a high growth share price, a business with lots of exciting potential. It needs to retain dividends in the business, therefore it doesn't pay a dividend, therefore the dividend per share is zero, and so too is the dividend yield. So if you're investing in ASOS, you've got to rely on capital gain or capital growth as your source of shareholder return, rather than, for example, a GSK shareholder who may expect to get around about 5% a year just from their dividends. So that's been an introduction to and an overview of the two main shareholder ratios, which is dividend per share and dividend yield. And I hope you found it useful.